What's up everyone, my name is Chris. I'm a former engineer who was able to retire at 34 thanks to my investments, and my goal with this channel is to pass on my knowledge and help you get on the path to financial freedom. Today I'm going to share 5 dividend stocks that I currently own and plan on holding forever. Yes, I know forever is a really long time, but I do really like these stocks and my investing strategy has always had the long term in mind. These companies are all dividend aristocrats, meaning they have increased their dividend every year for a minimum of 25 consecutive years. Some of these stocks even belong to a more elite club, but we'll get to that in a bit. These increases in dividends are like getting a guaranteed raise in your income every year, and I'm getting 5 raises. Psh, catch me on my private island. Yeah, just kidding. No, I'll be reinvesting that money. Before we get to the stocks, let me quickly explain dividends and some mistakes I see people make when buying dividend stocks. A dividend is a distribution of some of a company's earnings to its shareholders. Dividends can be paid out in cash or in the form of additional stock. I like to think of a dividend as a little reward for being a shareholder. The company wants to thank me for putting my trust in them and investing in their company, so they give me money. Wait, that kind of sounds like a bribe, right? Forget that. Let's move on. So how do dividend yields work? Let's say the stock is trading at $100 per share. The company announces a $5 dividend for every share that you own. That equates to a dividend yield of 5%. Let's say another stock trades at $200 per share, but they also have a dividend of $5 per share. Their dividend would be 2.5%. Too many people try and chase high yields. They think that that's the fastest way to build passive income, but the odds are the high yield is either unsustainable or due to a significant fall in share price. You need to look into much more than the yield before choosing a dividend stock. Here's a cheat sheet of everything you should be looking for. As we go through the 5 stocks, I'll pull up this checklist and we can see how each stock does. I'll leave a link to a copy of this cheat sheet in the description. Let's get started. Procter Gamble. Have you ever looked at the label of a household product? Odds are you will find the P&G logo on that label. Here are some of the companies owned by P&G. These are products we use every single day and will most likely continue to use every day for the rest of our lives. So it would make sense to own shares in the company that owns these products, no? If that doesn't convince you, let's look at the dividends. Remember how we mentioned that some companies belong to an even more elite class? Well, this is one of those names. Procter Gamble belongs to the uber elite dividend kings. To be a dividend king, the company must increase its dividend for 50 plus consecutive years. P&G has increased its dividend for 66 years straight. And this past year, the company increased its dividend 5% to 91 cents per share. Let's see how the company does on the checklist. 7 out of 7. Not bad, right? There's many reasons why this company is number 1 choice for me. Abbvie. Abbvie was spun off from Abbott Labs in 2013. Abbott now specializes in medical devices and diagnostic equipment, while Abbvie is a research-based pharmaceutical company. In our opinion, either company will be a great hold for life, but we're going to focus on Abbvie. Since 2013, Abbvie has had a ton of success, mostly coming from the best-selling drug in the world, Humira. In 2020 alone, Humira brought in nearly $20 billion in net revenue. The concern is that Humira's patent expires in 2023. Resulting in a decrease in market share and the possibility that the company will lose a large amount of revenue. But Abbvie is a mega cap stock with a deep pipeline of drugs, including Skyrizi for plaque psoriasis and Rinovac for rheumatoid arthritis. In 2019, Abbvie acquired Allergan and its products, including Botox, eye care products, and women's health products. It is prepared for the patent cliff of 2023 and for many years to come. Dating back to its Abbott years, Abbvie has increased its dividend for 51 consecutive years, making it also a dividend king. Its current yield of 3.7% is just a cherry on top. Abbvie is a very strong company with huge growth potential and a fantastic dividend. Let's see how the company does on the checklist. 6 out of 7. Shows why I like it. Target. I wrestled between Home Depot and Target here. I own both of them and will continue to do so for a long time. I think Home Depot has more exposure during a recession as home building renovations and construction in general can come to a screeching halt. That's what made me ultimately choose Target. Many people believe brick and mortar stores are dead. While I do believe it is on life support, it is not quite gone yet. The Pandy did its best to deliver its death blow, but some companies were able to survive and adapt. Being able to adapt is a sign that a company will last a long time, and that is exactly what Target was able to do in 2020 and 2021. Target already had an online presence, but capitalized on an idea of using online for same-day delivery and contactless store pickup. The fact that this idea was implemented quickly shows me that management will continue to come up with solutions no matter the situation, and it will remain one of the leaders in the industry. In fact, Target reported sales growth of more than $15 billion in 2020, thanks in large part to digital sales. Target's current dividend yield is $1.08 per share, a 20% increase from the year before, and 2022 marked Target's 51st consecutive year of raising dividends, allowing it to join the uber elite dividend kings. Staying relevant, adapting, and continuing to grow are all the reasons we plan to hold it forever. Let's pull up that checklist. 7 out of 7, right on target. Realty Income. Real estate is a great cash flowing asset, there's no doubt about it. But people often refer to real estate as passive income. For me, that couldn't be further from the truth. Between managing rentals, performing maintenance, and responding to emergencies, real estate is definitely not passive in any sense of the word. But along came REITs, real estate investment trusts. They allowed you to invest in real estate and receive dividends without having to do anything. Actual passive income. And in our opinion, the best REIT in the market is Realty Income. Realty Income is one of the largest companies in the REIT space. They currently own over 12,200 properties, many which are net leases. A net lease is where a tenant is responsible for most of the operating costs of the property, making it a fairly low-risk asset. Here's a breakdown of the top tenants. The company just announced an acquisition of a competitor, VREIT, which has allowed the company to accelerate growth and become an even more attractive company to invest in. Realty Income is a dividend aristocrat with 26 years of consecutive dividend increases. The current dividend yield is 5%, over double the average REIT dividend of 2.1%, and the company just raised their dividend to $3.06 per share. Not to mention the dividend is paid out monthly, another enticing reason to own it. Definitely one we will hold for a long time. Let's take a look at that checklist. Only 5 out of 7. Sell it. Just kidding. That's still very strong, and I'm very confident in owning Realty Income for a long time. Enbridge. We don't recommend chasing dividend yield when investing for the long term. So while Enbridge's dividend yield is 6.6%, that is not the reason to own the company. But it certainly doesn't hurt. And neither does the fact that it's a dividend aristocrat, increasing dividends for 28 straight years. Enbridge is a Canadian oil pipeline giant. A majority of the company's earnings comes from its oil pipeline, which is estimated to account for 25% of all North American oil. Its natural gas pipeline accounts for another large portion of earnings, where 20% of all North American natural gas passes through. The rest of the earnings come from utilities and renewable energy. Now, I know what you're thinking. Isn't the oil industry on the way out? And as much as I want to agree, it is going to take a long time for that to be true. And the world still needs oil. Someone needs to move it. That's where owning the pipelines makes sense. So if you were Enbridge, wouldn't you use the current system to finance the renewable energy system? Well, that's exactly what Enbridge is doing, using its revenue to rapidly grow its renewable energy sector. Since 1996, Enbridge has been developing its renewable energies. It has offshore wind developments in Europe, it's building solar plants and investing in natural gas business, which is a much cleaner fuel than oil. And this company is adapting to the changing times and providing a ton of value to its shareholders. It's another great name that we want to hold for a long term. Let's head to the checklist. 5 out of 7. But even though the yield is higher than the range, Enbridge has proven that the yield is sustainable over the long term. So let's change that to a pass. 6 out of 7. Boom. There you have it. Dividends should have a place in your portfolio, and these 5 names are stellar companies with amazing dividends that you can count on for years. My goal here was to touch different sectors and provide a diverse group of stocks. There are plenty of great dividend stocks out there, but these are the ones that I will absolutely hold for the long term. If you like this video, be sure to hit that like button and subscribe to the channel. Let me know your thoughts in the comments and maybe what dividend stocks you would pick. That's it for today. Until next time, investors.